Hello guys, welcome back to Trader DNA. Take a look at this. Right here, after the price moved sideways around this moving average line, it suddenly broke out and surged upward. As a result, we secured an incredible profit from this trade. Now, let's move to the left. Here, you'll notice the price consolidating again near this remarkable moving average line before breaking out downward, delivering yet another substantial profit. Further to the left, the same pattern emerges. A sideways movement, a breakout, and another significant profit that far outweighs the risk we placed with our stop loss. So the big question is, how is my trading strategy so powerful that it consistently delivers high probability signals across nearly every trade setup? In this video, I'm going to reveal every secret behind this incredible strategy. The best part is that this strategy is so straightforward that I'm confident you'll be able to use it just as effectively as I do after watching this tutorial in full. Make sure to follow every single step I teach here without skipping a beat, so you can start experiencing how effortless it can be to profit from the market. Let's dive into the tutorial and get started. Let's begin our discussion with the moving average indicator. In this strategy, the moving average plays several critical roles. First and foremost, I utilize the moving average as a terminal for price consolidation. This is the central function of the moving average in this strategy. Why? Because we only enter the market when the price consolidates along or around this moving average line. Understanding the sideways market. A sideways market occurs when there is a near balance between buyers and sellers of an asset. When these forces are evenly matched, the price remains relatively stable, leading to a consolidation phase where no clear trend is apparent. These periods often precede the emergence of a new uptrend, a downtrend, or even the continuation of a previous trend. Sideways markets typically take place when prices fluctuate between two levels known as support and resistance. Support represents the price level where the decline tends to pause because there is sufficient buying interest to prevent further drops. Resistance, on the other hand, is where the price rise tends to stall as selling pressure intensifies. In this strategy, the moving average line serves as the area of support and resistance. In such sideways market scenarios, overall trading activity or volume generally remains steady because neither buyers nor sellers have a decisive upper hand. However, any significant spike or drop in volume can signal a potential breakout from the sideways market. That's where my strategy shines. I combine the RSI and CCI indicators to confirm the direction of valid breakouts after the sideways phase concludes. Now, let me show you how to effectively utilize the CCI, Commodity Channel Index indicator, within this strategy. To fully grasp the use of the CCI in this approach, you need to understand a few critical rules concerning the position of the CCI line relative to three key levels: 0, 100, and -100. So 1. The position of the CCI line relative to level 0. The rule here is quite straightforward. When the CCI line is above the 0 level, it signals that the price is trending bullish. However, this does not mean the market is in a confirmed bullish condition yet. At this stage, traders should not enter a buy position immediately, but should instead prepare to do so. This preparation phase can be used to calculate the potential stop loss level, estimate the minimum target profit, or handle other essential trade management tasks. Similarly, when the CCI line is below the 0 level, it indicates that the price is trending bearish, but the market has not yet entered a confirmed bearish condition. In this scenario, traders should refrain from opening a sell position and instead get ready to do so. This preparation time can also be used to manage trade-related tasks while waiting for a perfect sell signal to materialize. 2. The position of the CCI line relative to levels 100 and -100. When the CCI line moves above the 100 level, it serves as a strong indication that the market has entered a bullish condition and traders can proceed to open a buy position. Conversely, when the CCI line drops below the -100 level, it signals that the market is in a bearish condition and traders can execute a sell position accordingly. The position of the CCI line in relation to levels 0, 100, and -100 is absolutely crucial for the success of this strategy. You must adhere strictly to these rules to ensure that the trading signals generated are valid, both from a price action perspective and based on the CCI indicator's calculations. By following these guidelines with discipline, you can significantly enhance the accuracy and effectiveness of your trades using this strategy. Next, let's explore how to leverage the RSI, Relative Strength Index indicator, in this strategy. In this approach, we use the RSI indicator to confirm the market trend information provided by the CCI indicator. Specifically, we focus on the position of the RSI line relative to the 50 level. The analysis here is very straightforward. If the RSI line is above the 50 level, it confirms that the market is in a bullish condition. Conversely, if the RSI line is below the 50 level, it confirms that the market is bearish. Now, let's examine this in a practical example. In this chart, the price is below the moving average line, which indicates that the market is still in a bearish condition. Meanwhile, the CCI line is above the 0 level and pointing upward, signaling that the CCI reads the price action as weakly bullish since it has not yet crossed above the 100 level. On the other hand, the RSI line hovers around the 50 level, but remains below it, suggesting a bearish tendency from the RSI's perspective. This scenario presents a non-ideal setup because the three indicators are not in alignment. The moving average and RSI interpret the market as bearish, while the CCI suggests a weak bullish condition. Nonetheless, based on the first rule of this strategy, this market should be avoided entirely because there is no clear consolidation phase around the moving average line. This example highlights why discipline is critical when using this strategy. By waiting for the perfect alignment of signals and adhering to the rules, you can avoid unclear setups and focus only on high probability opportunities. Here's another example to further illustrate the application of this strategy. In this chart, the price is moving upward and positioned above the moving average line, which indicates that the prevailing trend is bullish. Next, we analyze the positions of the CCI and RSI lines relative to the key levels we discussed earlier. First, the CCI line is pointing downward and is below the 0 level, but has not yet dropped below the -100 level. This suggests that, based on the CCI analysis, the market is in a bearish condition, though it is not confirmed as a strong bearish trend. Then we observe the RSI line, which is also pointing downward but remains at the 50 level, indicating a neutral condition rather than a clear bullish or bearish trend. When you encounter market conditions like this, it's essential to simply disregard them. There's no need to spend time waiting for a clearer setup in such a scenario. Instead, focus your attention on finding other market conditions that meet the specific criteria outlined in this strategy. This example demonstrates the importance of patience and discipline. By avoiding indecisive markets and sticking strictly to setups that align with the rules, you can save time and increase the probability of success in your trades. Now, let's dive into a more in-depth discussion. In this chart, we observe a sideways movement around the moving average line. This is the first and most crucial condition that must be met for this trading strategy to work effectively. Based on my extensive experience with this strategy, whenever we encounter a sideways market around the moving average line as we see here, it strongly indicates a high likelihood of achieving significant profits in our trades. For this reason, if you do not find a sideways market near the moving average line, you must refrain from forcing this strategy onto the market. Instead, you should either step away from the current market or analyze other markets until you find this specific condition. As you can see here, when the market is in a sideways phase, you can easily draw a horizontal line above the series of sideways candles to mark the resistance level, and another horizontal line below the candles to mark the support level. When you examine the market conditions on this chart, it becomes evident to you and anyone else observing that this is a clear horizontal pattern. Is that clear enough? If you now have a solid understanding of what a sideways market looks like in the context of this strategy, then we can proceed to the next level of analysis. By mastering this concept, you'll set the foundation for leveraging this strategy effectively in your trading. Now let's turn our attention to the CCI, Commodity Channel Index Indicator. In the CCI window on this chart, the CCI line is positioned below the 0 level. This indicates that although the price is currently in a sideways phase, the market's trend is leaning bearish. From this, you can clearly see why the CCI indicator is so crucial. It provides an early perspective on the potential direction of the market trend, even while the market is still consolidating in a sideways phase. Next, let's analyze the RSI Relative Strength Index indicator. In the RSI window, it's very evident that the RSI line is already below the 50 level. This further strengthens our expectation that once the sideways phase concludes, the market is likely to trend bearish. With this in mind, a trader's next step should be to prepare for a sell position by planning a risk-reward ratio scenario that maximizes profitability. Up to this point, have you understood each analytical step required in this strategy? It's critical to grasp every aspect of the analysis and the informational value provided by each indicator used in this strategy. If you cannot accurately interpret the signals and insights offered by these indicators, you'll face significant challenges when trying to implement this strategy effectively. In this scenario, our primary task is to patiently wait for the CCI line to drop below the -100 level. If that happens, we immediately open a sell position and set the stop loss just above the nearest swing high. On the other hand, if the CCI line moves above the 100 level, accompanied by the RSI line crossing above the 50 level, we can also consider opening a buy position, placing the stop loss just below the nearest swing low. However, based on current market conditions, the most likely outcome is that the CCI line will move downward below the -100 level, and indeed that's exactly what happens. The CCI line drops below the -100 level. Following our planned strategy, we proceed to open a sell position, placing the stop loss either above the moving average line or above the nearest swing high. For our minimum profit target, we set it to match the lowest point of the price drop to the left of the current price. Alternatively, we can calculate the profit target using the risk-reward ratio of 1:2 as a guideline. And as expected, the market responds as predicted. Shortly after entering the trade, the price declines rapidly toward the target we had set. This example clearly demonstrates how the disciplined application of this strategy, waiting for the right conditions, adhering to the rules for entry and exit, and maintaining proper risk management can lead to successful outcomes. By following this process step by step, you can maximize your trading accuracy and capitalize on high probability opportunities. Let me demonstrate another real-world example so you can truly understand and master this powerful trading strategy. In this chart, it's crystal clear that the price is moving in a sideways phase, hovering around the moving average line. You, along with most traders, would likely agree that this situation qualifies as a sideways market. Once again, this is what I mean by sideways. It's crucial not to force patterns onto the market. If the chart pattern doesn't align with this definition of sideways, it's not applicable to the strategy we're discussing. Always remember this essential rule. This strategy only works in a specific type of sideways market that conforms to these characteristics. Next, let's shift our analysis to the CCI Commodity Channel Index window. Here we can clearly observe that the CCI line is below the 0 level, which strongly suggests that the market is leaning toward a bearish trend. This is an important clue that indicates the market is likely to transition into a strong bearish phase. Following this, we move to the RSI Relative Strength Index window. In this section, it's evident that the RSI line has dropped below the 50 level. This means the RSI confirms that the market, which is currently in consolidation, is now entering a bearish territory. Combining these insights from both the RSI and CCI indicators, I'm preparing myself to open a sell position. However, remain cautious and aware of the possibility that the market could suddenly reverse and become bullish. Such a shift would be signaled by the CCI line rising above 100 and the RSI moving back above the 50 level. Despite this potential reversal, the current conditions of the CCI and RSI strongly suggest that the market is more likely to continue its bearish trajectory. As the analysis progresses, we see a key development. The CCI line dips further below the -100 level, while the RSI remains under the 50 level. This is the precise signal we anticipated. At this point, I execute the sell trade, setting a stop loss just above the nearest swing high or above the moving average line. In this scenario, I chose to place the stop loss above the moving average line, with an initial target profit set at twice the size of the stop loss risk. And as predicted, the price swiftly declines, hitting our profit target with remarkable speed. This outcome perfectly validates our analysis and execution, showcasing the effectiveness of this strategy when applied correctly. Next, we encounter another instance of the same sideways pattern. As you can see, it's effortless to draw a support line below this series of candlesticks and a resistance line above them. This setup perfectly matches the core requirements of this trading strategy. The sideways phase must occur around the moving average line. This characteristic is critical for the strategy's success, and it's a recurring element that makes it reliable and repeatable. Shifting our focus to the CCI Commodity Channel Index window, we notice something significant. The CCI line is now above the 0 level, signaling that the market has a tendency to shift toward a strong bullish trend. This is an essential clue that indicates the potential for upward movement. Next, we analyze the RSI, Relative Strength Index window. Here it is evident that the RSI line has risen above the 50 level, confirming that the market, although still consolidating, is trending toward bullish territory. With these combined insights from the RSI and CCI, I prepare myself to open a buy position. However, I remain cautious and aware of the possibility that the market could unexpectedly turn bearish. Such a reversal would occur if the CCI line drops below the -100 level and the RSI falls below the 50 level. Despite this potential shift, the current conditions strongly suggest that the market is poised to continue its bullish movement. As the analysis unfolds, we observe precisely what we anticipated. The CCI line climbs above the 100 level, while the RSI remains firmly above the 50 level. These are the exact signals we were waiting for, confirming the validity of our analysis. At this point, I execute the buy trade, placing a stop loss below the nearest swing low or below the moving average line. In this particular case, I opted to position the stop loss below the nearest swing low. My initial profit target is set at twice the risk of the stop loss, ensuring a favorable risk-to-reward ratio. As predicted, the price surges upwards swiftly, hitting our profit target in no time. Remarkably, the price continues to rise significantly beyond our target, delivering even greater returns. This outcome not only validates the accuracy of our analysis, but also demonstrates the power of this strategy when applied correctly. As an additional tip for this strategy, it's important to note how to handle markets showing strong trends, like the one we are currently analyzing. A strong trend is often characterized by a series of bullish candles moving confidently upward, or by the moving average line sloping clearly in an upward direction. This visual cue is a key indication that the market is trending strongly in one direction, and we can use this information to our advantage for follow-up trades. In a market condition like this, we can execute additional buy orders using a simple but effective rule. Specifically, when the CCI line dips below the 100 level but remains above the 0 level and then subsequently rises back above 100 level, this creates a clear signal for a continuation trade. As demonstrated here, when the CCI line crosses back above 100 after temporarily dipping, we can confidently open another buy position. This approach allows you to capitalize on the ongoing trend with precision and minimal risk, as illustrated in this example. Doesn't that sound straightforward and practical? The beauty of this strategy lies in its simplicity and effectiveness. To make it even easier for you, if you'd like to use the exact same settings and templates that I'm using in this video, I've included a downloadable template link in the video description. This template will automatically plot all the indicators exactly as I've configured them, saving you time and ensuring accuracy. With this, you can seamlessly replicate the strategy on your own charts without any hassle. Lastly, if you've gained valuable insights from this video or want more trading tutorials delivered more frequently, don't forget to subscribe to the channel, hit the notification bell, and share this video with your friends on WhatsApp, Facebook, or X to help them learn as well. Your support truly motivates me to keep creating high-quality content for you. Thank you for watching, and I'll see you in the next video.